Right now is the time to buy a home. There's deals being made out there today, lower prices, seller concessions. There's even less competition. Now's the time to buy, refinance it later with the 2-1 buy down. What a deal. You get the seller paid subsidy refunded, which will pay for your refinance. And welcome to the 28th episode of the One Bite at a Time show. This is where we go out and find the most important information, the most relevant information in today's market right now, and we bring it to you one bite at a time so it doesn't bite into your day too much. First of all, many of you may have heard that Roxanne has decided to leave our company, so we will miss her and we wish her luck in her endeavors. That leads to the next subject. We have several subjects today. First of all, of course, we're looking for one or two more trained, active loan agents. So if you know someone, maybe somebody at a bank, because you know what, the mortgage broker world is really growing. The market share for mortgage brokers is just exploding. We surpassed back in 2019, we surpassed the bank's market share. And today we're up almost 69% of the market share today, according to MFAA. What this means is the mortgage broker world is doing mortgage loans better than banks. So if you know somebody working at a bank, they probably don't get paid very much. So maybe they want to move on. Maybe they want a higher comp plan. Maybe they want a little bit better opportunity to get better rates for their clients. Maybe they just want to jump into the broker world to feel more independent. We would love to have them talk to us and see if they're a right fit for vintage mortgage firms. So if you know somebody looking for the best follow-up automation system in the world, that's looking for maybe the ability and the opportunity to work on the One Bite at a Time show with me, Vintage Mortgage Firm is a wholesale direct mortgage broker, and we know what we're doing. So we'd love to talk to anybody you might refer to us as a new loan agent for Vintage Mortgage Firm. The next thing I want to talk about today is I want to go back again to the 2-1 buy down. Many of you are confused with this, and I want to make sure you're not confused with it because it's so important and it's becoming extremely popular. We're doing quite a few of them. First of all, a 2-1 buy down is not adjustable in any way. It's a 30-year fixed rate mortgage. It has a subsidy paid by the seller. In other words, in year one, your interest rate is 2% lower than the start rate. And in year two, the interest rate is 1% lower than the start rate. And how that works is, because your interest rate's still the same, but during the first year, the seller subsidy, they're paying almost 3 points, closer to 2.7 or 2.8% in order to buy down the rate for those first 2 years. And that subsidy is going into a subsidy account and augmenting the buyer's payment for the first 2 years. What this means is there's money in that subsidy account. So if the buyer were to refinance sometime in the first 2 years, whatever's left in that subsidy account gets refunded back to the buyer. Now, we all know, at least most people know in the mortgage industry, we have a very high, strong reason to believe that interest rates are going to be significantly lower in 2023. And people shouldn't wait till 2023 to buy a house, because right now is the opportunity to buy homes with less competition and they can get good deals. Maybe they can even get seller concessions. And this is why it's so important people buy now and refinance later. And what I mean by that is if they refinance within the first 2 years, they're going to get a refund of the subsidy amount, which will help pay for their refinance. So they're not paying the cost of a refinance again. Let's just say, for an example, here's a $600,000 purchase. And for an example, in this example is 20% down. It doesn't have to be 20% down, but in this example it is. And it's 7% going rate today. That would make the payment $3,193. All right, that's good. But in this particular example, on a 2-1 buy down, the payment's going to be 2% less for the first year. That would make the payment $2,576 a month. That's a $600+ savings, and that's awesome. But if that buyer were to refinance 6 months later, they have to wait 6 months, then they're going to get a refund of almost $9,600, which is going to more than pay for the closing costs on the refinance. Maybe there's even more money left over to permanently buy down the rate from that point forward. So make sure your buyers understand this is the time to buy. That'll be the time to refinance. Get into your deal, find the right house. You got lots more opportunity, lots more inventory right now. You can make deals, get the deal, refinance later, have the seller pay for it all. This is so important to understand. A subsidy, 30-year fixed rate loan, and it's a great opportunity right now, and it's extremely popular. So make sure you understand what you're doing out there, guys. One thing to remember about 2-1 buy downs, or in general, you need to understand what the maximum seller contributions are based upon the loan amount and the down payment the buyer puts down. So I'm going to run through these real quick. Here's a chart to explain it. If your buyer is putting on a conventional loan, if your buyer is putting less than 10% down, this maximum seller contribution is only going to be 3%, which means maybe they can pay for the seller subsidy on a 2-1 buy down, but nothing else. However, if your buyer is putting down 10% or more, then the seller can pay up to 6% in seller concessions, which is happening a lot right now, whereas the seller is paying not only for the subsidy amount for the 2-1 buy down to lower their payments for the first 2 years, but they're also paying for all their closing costs, prepaid interest, prepaid taxes, prepaid insurance, and things like that. Just understand. Also, if the buyer puts 25% down, the seller can put up to 9% towards seller concessions, opening up lots of different opportunities there. Understand, on an FHA loan, the maximum contribution is 6%, and a VA loan is 4%, and a USDA loan is 6%. So just understand those when you're making these deals. If you're working with a sharp, smart mortgage lender like me, I'm going to know those things for you already. But you should know in order to make the deals, make the offer, talk to your clients, talking points, things you should know. Now, here's what a loan estimate would look like. This is important because everybody's wondering how this works. And so the loan estimate shows it really well. So here's an example of a loan estimate. It's a different price, different purchase amount, different loan amount, doesn't make any difference. I'm going to direct your attention towards the center part in these columns, and you'll see 4 columns. In this case, because there's less than 20% down, there's mortgage insurance. That's why the 4th column. So column number 1 is year 1, then you got year 2, and then you got year 3 through 11. And then in this case, because private mortgage insurance will drop off at year 12, it's showing year 12 on through 31. This is what a loan estimate would look like with the subsidy. Now, going to the second page, if you go to block A under loan charges or loan costs, this is where you're going to see that seller subsidy. In this case, it's 2.79%. Yeah, I said 3%. It's lower than that, about 2.79%. This example is 2.79%, but that's paying for the first 2 years of subsidy payments. So again, when I say subsidy, the interest rate being paid on the loan is still 7%. But in the first year, the seller's subsidy is paying the difference. And in the second year, the seller's subsidy is paying the difference. The interest rate for the buyer is changing, but the interest rate that the lender is receiving is the same as what they would have in normal situations. That's why this loan doesn't cost anything other than the cost of the 3 points, or almost 3 points for the 2 years. Next thing I want to do is switch directions and give you the conforming loan limits. Some of you know these, you've heard them already. We're already able to use them on all loans except for FHA. FHA requires a case number as of January 1st, but VA, we can do VA as well as conforming for these new conforming loan limits. Of course, VA, the conforming loan limit now is the same as the conforming loan limit for conventional loans, which is $756,000. And then on a duplex, it's $829,000. On a triplex, it's $1,123,000. And on a fourplex, $1,396,000. And of course, if you're in a high cost area that starts at $1,089,000 all the way up to the fourplex, which is $2,095,000. On a VA jumbo, we can still go to $2.5 million with 0 down payment. Understand that. If it's out there, Vintage Mortgage Firm can do it for you. We can do every loan in California, every type of loan in California. Now, if you want to know, you want to bookmark your browser to see these conforming loan limits. I do, because it's easy for me to flip around and see them. Here's the URL you want to go to. If you got an email with the episode 28, you can go back there. You can copy it from that email. Otherwise, it's right here on the screen. You'll want to go to this URL, and you'll also notice in the middle of that page, when you open it up, there'll be this writing that you'll see. And I want you to click on the PDF document. That won't require you to download the Excel format every single time to your computer. PDF, pop it up anytime you want to see it. This is a great thing to bookmark for your browser, so you know how to find this every single time. You can also Google conforming loan limits, and you'll find it in one of the top 10 results as well. Anyways, that's episode 28. We're going to wrap this up with a little bit of real estate humor, and we look forward to seeing you next week, episode 29. Oh, Shadow came up to say hi.
Oh my gosh.
Where's all your money gone, Daddy?
Taxes. 9, 10, 11. Let me fix my houses. But it's okay. It's part of the game. No, it's not. It's not fun. It's not fun to what? It's the worst part of the game. It's what? Taxes.